Welcome to Keen on Retirement, a show dedicated to helping you thrive before and during your retirement years. If you are looking to grow and protect your wealth and want to make the second half of your life the best half, then listen in as wealth advisor Bill Keen sorts through the key issues that you need to know in a lively and candid way.
Hello, everybody, and welcome back to Keen on Retirement. I'm your co-host, Steve Sandusky, and looking at me all chipper and happy, Bill, Matt, great to see you guys again, as always.
Mm-hmm. Great to see you, Steve. I'm always happy when I get to see you and record one of our podcasts here after 10 years of being on the journey with you, so to speak.
Yeah, we don't look a day older either, do we?
We do not. In fact, who was that character? Benjamin Button? He ages in reverse.
Yeah.
That's Carissa making me put on my sunscreen. You know, we're down at the lake house and everybody's hiding in the shade and I'm sitting over there trying to chase sun. And she's like, "What are you doing? You know, you're almost 57 years old. You've got to take care. Quit sitting out in the sun like that." But so I'm working on that. I'm listening to her.
You're getting your vitamin D.
Yeah.
That's right.
Well, with these camera filters these days, you can make yourself look a lot younger.
That's right.
But I don't think
smooth out the wrinkles.
I don't think this software that we're using is doing that, is it?
I've disabled it.
Well, that's because Matt's the young one here, so he's still, he doesn't have any wrinkles yet.
Well, there's another way to do that, and that is to use a webcam that's not high resolution.
Okay.
Yeah. So,
but our show, it's advanced now, so we have to use high quality equipment.
Yeah. That's right.
Well, speaking of summertime and the sunshine, I guess the kids all have now gone back to school here, and so that's a good time. We still have one in high school, and then we had one that we took off to Arizona universities here last week. So that's exciting times. Matt, I know your two are back in. Steve, your grandkids likely, right?
Grandkids are too young for school yet. But
Too young for school. Okay.
Too young for school. Yeah,
little ahead of me. I guess I was aging you a little faster there than.
Mm-hmm.
Yeah. No, they're just coming up on a little over 1 at this point.
Okay, that's right.
So
I know that.
Got a few years before school starts.
I know that. That's right.
Yeah.
Well, Matt, you were recently. We had a listener. I ran into. It's really interesting. I run into listeners and viewers around places, and somebody approached me. I mentioned a doctor in the Ozarks here. I think an episode or two that came up and mentioned he listens in, and somebody else approached me here recently, and they said, "Hey, Bill, you talk a lot about your flying and some of the angel flight work that you do, and Steve talks about his mountain climbing and all of his sailing." So I knew he was a listener. He wasn't kidding. Now, hopefully he listens farther to get into the meat of our topics instead of just that. But he said, "I wish Matt would talk more about his race car stuff." And I said, "Well, we want to eventually get to the topic here." But he actually said he enjoyed it. So, I mean, you were off in, I guess, would you call it? Was it by the Catskills there in New York, or was it the Poughkeepsie area?
Yeah, it was Connecticut. So about a couple hours outside of New York, we were racing up in Lime Rock Park, which it's a track that's been around a long time, I think since the 50s. Of interesting layout. It's a very short track. There's, call it 7 turns. It's less than a minute lap, and it was a ton of fun. Sometimes you wonder if those short ones would be as enjoyable, but it was a great track. And the claim to fame, I guess if people have raced and kind of know about it, I'm sure they've heard of it. Paul Newman was a regular there when he was racing, and I had heard from some of the locals that he owned a house nearby and would race there all summer when it was open. So
very nice. Very nice. And so for some of our listeners, and again, we do have an episode today where we're going to be answering listener questions on the program, which are some of the most highly listened to and applauded, I suppose, episodes that we do because we're looking behind the curtains at things that are on your mind as listeners and viewers. But Matt, so that our audience understands what you do, when you first started racing, you were doing mostly time trial work where it was just kind of fastest lap as far as the time goes. But now you're into a custom. Your vehicle is called a Rush. It's a custom-built race car. It's an open-wheel race car. So it's a one-seater. You've got a 4-point harness, fire suit. You have a helmet on that you wear, of course, for safety purposes. And you're getting with it out there, I should say, with probably 30 or 40 racers. And you're now not just racing regionally against New York. You're racing nationally. Oh.
Yeah, it's a national series. It's a lot of fun, and we have our own spec class. So yeah, there's anywhere from 25 to 45 cars in the field, all exactly the same. You can't do anything to them, and they really scrutinize the top 5 after every race. Look at all the components and make sure people aren't cheating. So far, no one's been caught of doing anything illegally, which is good. But it's all for fun. I don't think anyone's at this stage. No one's getting paid or moving into the professional ranks. But it's definitely more challenging and a lot more competition, which I enjoy.
Well, what I like about what you're doing, there's a couple aspects as it relates to our audience, and that is one, you work really hard at Keen. You've been here. We've been working together for almost 24 years, and folks really appreciate your approach to financial planning, to investment management, the data that you look at, the very measured data, but you apply that same. I've just witnessed it methodology to your racing. So it's interesting how you all. Most of your guys that I know that do it with you, you all got like high-tech Garmin equipment. You're filming entry points into corners, exit points, braking points, things that your layperson would have no idea that how to get yourself, how to be better, how to be aware of things. And so I think that's pretty impressive. But having a hobby, you work hard here, a lot of hours, a lot of time, a lot of commitment, but you actually have a hobby that you're able to focus on also when you're not here and really dig deep on that. And it's kind of cool, Steve. I'm a benefactor of Matt's. And hey, not only me, but every team member at Keen and our clients as well are a benefactor of his dedication to, excellence. I would say so. Pretty cool. Up to and including the fact that he's now a race director in the Midwest region. So some days he doesn't race here in the Midwest. He's actually the race director. So he's the one that's looking out for our people cheating or are there conflicts out there at those races. So anyway. There you go, Brandon. I gave you a little bit of history there, and Matt did on his racing today.
That's right. Yeah.
I think it's great, though, Matt, that you do it. I think your last race is coming up next week or so, and then that'll be it for the season, right?
Yeah, we head out to the other side of the country. We're going to be out at Laguna out in California at the end of September. So that's the final event in that series.
So when are you going to turn pro?
Once he retires from here, it'll be quite a while, Steve.
Yeah,
I'll just answer for him.
I think that might be a pipe dream, Steve.
Now he does
I'm
have
a little old for that.
He does have Keen Wealth on the car. It's actually very cool wrap he has on the car with Keen Wealth on it, and he takes our tents and things. So we've had people approach him at races that recognized, the brand. Kind of cool too.
Mm-hmm.
Yeah.
You're not too old, Matt.
Yeah, according to the F1 movie, you can be 50 years old and be a pro F1 driver.
Yeah. So, all right. Yeah. So before we go to our listener questions, give our listeners, viewers just a quick thumbs up, thumbs down on the new F1 movie. What was the name of it? Was it just F1? Brad Pitt, right?
Yep. F1. I think the movie was the name of it. And I would give it a thumbs up, people. It was a good story and definitely fun to watch.
But folks, like in any industry, when they do movies on whatever you specialize in, my daughter's a doctor. She says, oh yeah, some of that is kind of embellished. So some of this was too, I suppose, but a good movie though, a good watch.
Yeah, that's right. Yeah.
Okay.
Good. All right. Well, should we jump into our listener questions
Let's
here
do
after close to 10 minutes here? I have an intro. All right. So the first one we have here comes from Karen. And she wrote in, I heard some 401k plans are starting to add private equity investments. What does that actually mean for someone like me saving for retirement? And I think probably a good place to start in answering that is, let's define what is a private equity investment, for in case folks may not know.
Yeah, that's really a catch-all term for what I would say are private investments in illiquid or less liquid securities or investment structures. So this could include like real estate. There's private credit, so it's lending money as a group of people get together, and that's what this investment vehicle is. It's a group of people typically run by a manager, maybe a subset of many managers, and they might lend money to private companies that provide higher interest payments that aren't available on the public markets. So when I say the public markets, it's just like what trades on the stock exchanges, and you see the S&P or the Dow or the NASDAQ. Those are the public markets. Private markets, well, they have equity and they have debt, and there's people financing those, but they do it in various vehicles or direct. And but that private equity is kind of a subset of that, or at least it's a catch-all term for all the different various ways that these things are structured.
And there's also some rules and regulations in terms of how do you qualify to be able to purchase a private type investment versus a publicly traded. Like I go to my brokerage account and I can buy a stock or a bond.
That's right.
Versus this private stuff. Like, just give me a high level on what are some of the restrictions or requirements.
That's right. So, typically they've had, and this is really what this comment is about, is Trump's executive order, which came out just recently, that is really looking at how do we provide more access to these vehicles, because currently they're limited to what are considered accredited investors. So you either have to have a high enough income. I believe it's 250,000, or maybe even higher than that.
Showing 200 individually or 300,000 jointly and a net worth of $1 million.
Yes.
Excluding your house.
So it puts a lot of what we call, a lot of folks would qualify for that.
Yeah. The thresholds aren't that, significant, where it's eliminating majority of the population. There's probably a lot of investors that could qualify for that. But then too, they're also not necessarily easy to find out about or learn about unless you're, have an advisor that is communicating these products to you about these. Typically, they're even lumped into like the category of alternative investments. They're alternatives to publicly traded vehicles like stocks and bonds. So, with this executive order, it doesn't necessarily just say, okay, now they're in there, but the idea being how are these things going to be structured to allow that to happen? If, the custodian and the plan fiduciaries believe that adding them to the investment lineup makes sense, then, there has to be structures around, well, how do people put money in and how do people take money out? Because the common way these are put together is you might invest 250,000. That might be the minimum investment, which would be pretty low in some cases. Or they might have capital calls. So you commit a certain dollar amount, and over time, as they're investing in these private companies via equity, debt, or buying real estate, whatever the structure is, they'll ask for more money from the people who committed to it to pony up. Okay, it's time. We need more, and you got to commit that capital when those things come in, and then they have illiquidity components to them. So you can't just turn around and sell it because you need the cash back. They might have, some of them might have more perpetual, like, hey, every quarter you can indicate if you need some funds back. There might be a cost associated with that, depending on how long you've held the investment. Others just have lockup periods that say you can't get it back for 3 years or 5 years, whatever the terms are. So they're all unique in that part of it. But a 401k is like, well, you put in $50 a pay period or $200 a pay period. Well, if you want to put it in that, and that might only be a percentage of what you're putting it in. Well, how's that going to work? So there's a lot of questions that have to be answered if this is even going to happen, which that goes more to the structure and the function. But then I think the more underlying question that she has is like, well, is it something that if I did have access to it, is that something I should look at? And, there's, as with anything, there's pros and cons. I mean, we've already kind of talked about some of the issues like illiquidity. So are they going to be as liquid? Can you get your money back? But I think the bigger issue, and especially when we evaluate alternative investments, we have access to pretty much any of them under the sun, and we could create our own if we wanted to, which we choose not to. But you can do that. That's all allowed within the regulation as long as everything is put together correctly and disclosed correctly. But there is a significant amount of fees associated with these. So, of course, Wall Street's real excited about this. And I think that's part of why you're seeing some of the headlines around it is, well, Wall Street's going to be they're going to figure out those issues because they want to put these products in 401k plans because there's just not much access to just the regular investing public. Well, now with the 401k and how big those retirement plans are, hey, we could get a small piece of that and we could charge 2-3 or more % a year, plus maybe some performance fees. And that's going to add up. I mean, I've seen many articles where the hedge fund manager, which is another similar structure that kind of gets lumped in with private equity. They're buying and selling things, and that's what some of these movies about, The Big Short. Who are these hedge fund guys that figured all this stuff out and made all this money? Well, over long periods of time, what ends up happening is the hedge fund owner or owners, they make a lot of money, and the clients generally don't, and it's because so much of it gets eaten up with the fees.
Right.
It's crazy. Right. It is pretty wild to think about.
When we look at some of these that come across our desk, and we do see the 2 and 3% fees, and then some, like Matt said, there's some that have what are called, some of these private equity or hedge funds have got something called the 2 and 20, and the 2 and 20 is 2% management fee plus 20% of the profits over some kind of a benchmark or a hurdle, and these are things your typical 401k investor has no idea about. And of course, when you look at who was lobbying for this, and we're not completely poo-pooing this, we're just talking data here. Well, the lobbyists representing the private equity industry have been actively advocating for inclusion of private equity.
You want access to this market
in the trillions and trillions and trillions of dollars of retirement accounts that basically, I say middle America has, but all of America has access to, and I think it's probably going to be highly scrutinized because not to get necessarily too technical here, but if even at Keen here, we offer a 401k, of course, and a profit sharing plan to our team members, and we have a fiduciary responsibility to our team, just like we do to our clients. But we have that same duty to our team to make sure that what we're offering them is reasonable and in their best interests, and that we've vetted these things. So it's going to be, all of these 401k providers are going to be extremely diligent in making sure they're doing their due diligence, and so that they're not putting themselves at liability, hopefully because they care about their team members and employees, and not just because they're afraid of liability, but that is definitely a factor. So, and a lot of times we look at what will get people to their destination, what will get our clients that we advise to their destination long-term in life. Does it require some sleeve of their investment in these alternatives, or does it not? And that's, honestly, I believe that it does not, would be my opinion. It does not require some allocation to these private investments that are higher fees, that are in some cases pretty illiquid. Now, I'm sure they're going to come up with ways to carve them up in little pieces so that the smaller investor could still get access to them through these plans because of the, like Matt said, the scope of the market that it would open up for these big money players and private equity firms. But then the question also is going to become, if something is getting watered down to the point that it's being offered to somebody for $1,000 or something, just how good is that offering? Would be a natural question that anyone would have, I would think. Is this the same investment that's being offered to the multi-billionaire people that have direct access into major brokerage firms and brokerage houses? Well, of course it's not. Of course it's not. And Matt, you also mentioned these private companies that are smaller, they pay higher interest.
Mm-hmm.
Why do they pay higher interest? Again, maybe you do think I'm poo-pooing the idea, but why do they pay higher interest? Why do they pay more, 7, 8, 9, 10%?
Well,
because
in
it's
any
more
market.
risky.
Exactly.
They're smaller firms. They're more risk, and of course they diversify things and try to spread that risk out and those things. But these are all factors to consider. I've been in the business 34 years, and I've gotten to see over that time frame the evolution and the cyclical nature of different fads that come out. I'm not saying this is a fad. I'm just saying there's different ways that Wall Street has come up with to push different product that does extract more fees off folks, all the way down to middle market and lower market investors. And so I look at also that with a raised brow too. Again, not making a blanket statement about every single one of these offerings, but just saying I've seen that happen a lot in over 3 decades of being in practice. So,
well, and what they do is they increase complexity. So that's part of it. That's, we think about most folks, they want to simplify their lives. They want to consolidate assets. They want, a place that has everything under, one roof, can do all the tax planning, do all the financial planning. And they don't want complexity, especially as they get older. Well, these just increase complexity. And they can increase complexity regarding your taxes too. So not only do you have to understand the product, but then your tax situation could be different now because a lot of them issue K-1s, and that adds a whole nother layer to your tax return. So, while, it sounds exotic and exclusive, and has these things kind of like, oh, you're going to have access to all the best people, the smartest people in the world. It's like, that's really not true. So,
right. And even you say that about the tax return. And I mean, a good portion of our clients that we work with that are probably followers of our show. And there's nothing wrong with having to extend your tax return past, the approximately April 15th filing date every year. But a lot of our clients like to get things buttoned up and filed and just be done, put it behind them for the year. And many of these, especially, and now we're talking about in IRA accounts, 401k accounts, how they'll deal with the different tax reporting there. Hopefully there's not, hopefully it's slightly simplified, but outside of an IRA, almost every case you're extending your returns because the K-1s haven't come yet. And even just that little irritant alone could be something that might steer someone clear if they believe that we don't really need this asset to get to our destination. So, but it's good to talk about because it is being bantered about. But what's funny? We talked about the lobbyists. I haven't heard any of our clients just speaking or listeners or people that we're talking to ask. Have you had anybody ask about this, Matt? I haven't really had anybody ask about it other than this listener question today. So
I've
maybe
had a
people
few comments about the headlines, but not about, hey, I want access to that.
Right. What do you think, Steve? I mean, we're just, telling you all about our side of it here.
No, I think everything that you've said is fair. And, it reminds me of Occam's razor, which is this idea that if you have multiple potential solutions to a problem, you should probably go with the simplest one.
Yes.
And I think in this case, the simplest is stocks, bonds, cash, maybe some real estate. There's some publicly traded real estate. So, and what's the least complicated yet highest probability portfolio that's going to get you to what you need to do?
That's
right. And historically, that's basically been stocks and bonds have gotten you there. Today, where I may digress a little bit from you guys is today we have so many other potential investment opportunities from the things that we're talking about here, like the digital assets, the cryptocurrencies, and that sort of thing, which is a whole nother level of complexity that a lot of people probably aren't even interested in, and that's totally fine. But I do find all that stuff personally fascinating, and I think certainly with the Trump administration is extremely favorable to these new types of digital assets. And even if you don't invest in them, what we're definitely seeing is that the infrastructure of the financial system is starting to move over to some of these new digital technologies. We talk about the blockchain. We talk about, well, we haven't really talked about stable coins, and we don't need to get into all that, but there's definitely some new technologies, some new networks that are available today that are changing our whole financial plumbing. And again, we don't have to get into this, but one of the fascinating things I'll just tease people with is today our whole system is account based. Like I have an account at Schwab, or I have an account at Fidelity, or what have you. I have an account at the bank. In the future, it may be switching to a wallet based system. So think like Venmo. If anyone's used Venmo and you're sending cash to someone through an app, it's a similar type concept that we can digitize cash, we can digitize money market funds, tokenize them is probably the more accurate term, and you can send money around that way. And anyway, again, we don't need to go down that rabbit hole, but I do think there's a lot of interesting things happening here. But I think for the typical investor, the typical retiree, putting private equity investments and cryptocurrencies in your 401k plan, there may be special cases where that makes sense. But for by and large, for many people, probably not necessary at this point.
What I'd like to see is folks just increase their participation
That's right.
in their 401ks so that they're participating more. They understand the ebbs and flows of the capital markets. They're not afraid of the downturns. They understand they should be focusing on the number of shares they own, not just necessarily the price the value they're seeing in their 401ks during times where the market's going through a temporary decline, and not pull back from investing, but investing more if they can, as they can over time. And especially when you're younger, and even when you're, even closer to retirement, making sure you have the appropriate amount of diversified equity investments in the portfolio so that you can achieve the growth that you need. Like that would be the foremost thing that I would want to see. And that takes it back to that simplicity thing here. Let's just make sure we're maximizing our accounts. We're paying attention to, should it be going into the Roth 401k or the pre-tax 401k? And that's going to be just determined by doing some financial planning around it. So less about these sleeves of alternatives and more about the bigger, broader financial planning and having some awareness around that, and really leaning into what we know does work long term, albeit not a straight line up, but understanding those things. I remember it just came to my mind when I talked about the cyclical nature of these things. And Steve, you might remember this. Matt, you've heard me talk about it, but back in the mid 90s, what was big was this investment called managed futures was making its rounds through all the big brokerage houses. And it was a portfolio of futures that were being managed. This sounds pretty exotic. And if I recall, I think the fees on that were something like 8% annually. Wow. It was absolutely astonishing. And of course, back then, we're talking mid 90s now, 30 years ago, they were saying, oh, everybody needs 5%, 10% and managed futures as a something that's not correlated to the broad markets. And I remember at least one of those going bankrupt and going into a bankruptcy court. People, all they got back was the money that happened to be in money market at the time, which was like 8% of their 6% of their total account values or something. So again, not raising this big red flag that things are going to all go bankrupt here. I know there's going to be, especially in 401ks, a lot of research done, but just recognizing the trend of things coming in and out of favor with Wall Street trying to push things out to your individual investor.
Yeah. One thing I would just add is I'm all about innovation. I'm all about choice and all about options. And so I think a lot of these things, they expand possibilities. And while all these things aren't right for everybody, there may be situations where they make sense for certain people. And so I am a fan of the availability of some of these different things. And this is a perfect example of where a financial professional comes into play because they study this stuff all day long. I mean, this is like their professional life. And so it's really helpful to go through a professional as you vet this kind of stuff, and they can give you the pros and cons and the red flags to watch out for. So another good reason why it really helps to have professional guidance if you're going to really stray from some of the more traditional types of investments.
That's right. That's right. I was just, before we go into the next question, I'll share with you. I was just this morning, I spent about 4 hours today with, I think there was 11 other CEOs, leaders of investment firms that custody their assets with Charles Schwab, like we do at Keene. And we had some of the very top leaders of Schwab came in to do a roundtable. So it was nice here at Overland Park, Kansas. So we had a nice chat today, and some of the topics were around. Well, it was around cybersecurity, huge issue on all of our minds. It was around crypto. What questions people are being asked and how they are handling that with their clients. Not many of us talked about people coming to us wanting a big allocation to crypto. One gentleman even said, well, the first thing I do is I ask my clients these are typically in their 60s and 70s. He said, it was kind of tongue in cheek, but it was funny. And he said it was true. He said, well, let me ask you first, how are you with remembering your passwords? And he said, if a client says, yeah, I'm not very good at that, I always lose my passwords, he said, maybe that'll be a sign to divert them away from having some of these active wallets and things at this point. Not that they can't figure it out later. And then we also talked about AI too, but again, I'm deviating a little bit from our topic here, but some of the things that we're chatting about are being ahead of the wave and paying attention, and which is what we're doing right now, is discussing some of these things that are coming to market as just life and technology and options evolve.
Yeah. I think, you got to keep this stuff on the radar. At least the financial professionals have to, because you're getting paid to sort through all of this stuff and figure out what makes sense and what doesn't make sense. So
that's right.
It's good that we're talking about it. All right, let's jump into the second question here. This comes from Linda. And Linda says, I just read in the Wall Street Journal that people's retirements are more tied to stocks than ever. And since I'm already retired, should I be worried about that? So I'm imagining you guys read that article. So what did the article say, and how should we be thinking about that? How should retirees think about
it? Yeah, it was interesting because, we finished speaking about alternative investments and getting access to these 401k plans. And then now, this article makes it sound like, just reading the headline, Americans' 401ks are more tied to stocks than ever. And it's like, well, it's written as though that's a bad thing.
Yeah, I'm saying thank goodness, right?
Yeah, like, okay. So further readings through the article, but it kind of grabs your attention like, oh, is there some concern with that? And, they didn't necessarily go into a lot of like, hey, there's a problem with it. But really what they were focused on in the article was, well, the market's been performing well, and people tend to continue to own stocks and maybe buy more stocks when markets are trending higher, and maybe do the opposite. Emotionally, they want to sell stocks and own less stocks when markets go down. And even playing into this article kind of mentions the government and Congress and the Federal Reserve, like, well, they've basically kind of done anything they could to prevent downturns. So people are conditioned to these downturns not being that significant. And the article mentions, yes, even as recent as 2020 and even 2008. And I'm like, well, 2008 didn't just come back to all-time highs. It took quite a ways after going down 60%. So, just to put that in perspective, the market peaked in October of 2007. It stopped going down in March of 2009. COVID, it was 40 days before it stopped going down. And it was, yes, it was volatile, and it was a big drop in 40 days. And then by the end of the year, and actually by August, it was already back to where it was prior to the COVID situation.
Which you did call, by the way, and we are not market timers, or we don't purport to have a crystal ball, but just might as well circle back to that.
Sure.
Steve, remember Matt talked about by the end of the year based on data and historical drawdowns and some technical things that we don't probably beyond the scope of this. He predicted that something like that would happen, and because of the government-induced nature of the recession. But so anyway, good job, Matt.
Yeah.
5 years ago now, which is crazy to think it's been that long.
Yeah, I know it's been, and well, that's the thing. It's like written like, oh, those things. And it's like, well, in 2022, the market dropped 25%. I mean, that wasn't even that long ago. And it's just these happen all the time.
Well, a few months ago, we were down during the tariff tantrum, as we called it. 20% intraday, at least 19% on the close, right?
Yeah.
For the broad market. Yeah.
And I mean, markets come back, and there wasn't any intervention in the most recent one besides just the pause of the tariffs and the headlines just kind of going away for a while. So, it's a common thing. So ultimately it's like, it's less about people being exposed to the stock market or relying upon this. It's more about, well, what we were talking about before, what's going to get them to their destination, and how old are you, and how much should you have in stocks? And we know they go up and down. No one knows how much and when.
I always don't like it when somebody says it goes up and down. It goes up with intermediate periods of decline that are temporary in the upward advance.
Sure.
So if we said it goes up and down to your layperson, they would just think it looks like a heart rate monitor. Just up and down,
it trends higher, that's for sure.
Around a straight line, but it's been ever upward, at least for the last several hundred years. So, all right.
Mm-hmm. So, yeah, I mean, markets, they're volatile. That's what happens.
That's right.
The returns aren't printed on a daily or an annual basis like clockwork. I mean, some years are great, some years are down, most years are positive. It's just part of how it works. And thinking that that's a bad thing is it's like, no, it's not. It's just understanding how it works. And then when are you going to need some of this money back to live on, or even if it's outside of your retirement account? This is talking about 401k plans, but if you're saving for a down payment on a house and you're going to spend that money in the next 6 months, it shouldn't be exposed to a downturn in the market.
Yeah,
it could work in your favor, or it could not. I mean, you don't know. So there's an allocation that makes sense for everyone. So owning stocks, though, for most people is definitely a great thing. It's just not everyone is comfortable with seeing these temporary declines, and especially when they're retired or getting close to retirement and looking like, hey, we're going to have to, start to pull some of this out. But people think like, well, when I retire, I need it all. It's like, well, you don't need all of the money at retirement. You just need to, figure out how to take distributions out of it.
Mm-hmm.
That's the money you need, is the money you're pulling out to live on, not the entire balance. If you have enough money where you could live on the dividends that are produced, you may not need, you could be 100% stocks. I mean, again, it's different for everybody. So a blanket statement like that just makes people think, oh, like that's a bad thing. And, it's just, it's misleading, more of a headline grabber than anything else. But the positive is people are probably underexposed, and especially at younger ages too.
Well, I'm looking at that right here. You teed it up for me in this article that we were able to find here that she quoted. It said workers in their 30s had 88% of their 401ks in stocks last year versus 82% a decade earlier, according to the Vanguard Group. Now, I would contend, as long as you're diversified and you've been trained and you understand and have the wisdom of the equity markets long term, that both of those are underexposed to equities. When you're 30 years old, this is 30-year money at that point, at least maybe 40-year money. And like you just said, you don't need it all back at retirement. So it could be multi-generational resources, but even forget that, just it's at least 30-year money. Again, this isn't financial advice for anyone specific, but to me, this person that has 82% a decade ago or 88% now, that's 30 years old, those percentages in the equities, when we say equities, that means ownership of company shares or stocks, and several ways of saying it. They will look back if they left that allocation alone. One, the stocks will slowly overtake the allocation of bonds if they never change anything, because stocks do way better long term. But they will look back and say, why did we have that money in those bonds for 30 years? Because the bonds will have maybe doubled once or one and a half, and the stocks will have gone through the roof long term. That will happen. And they'll say, why did we even have any bonds in there? Again, as long as it's diversified and ideally rebalanced among sectors of the markets, of the equity markets as well. So I would contend that 88 or 82, again, not specific financial advice to anyone listening, do your own plan and get comfortable yourself with your risk tolerances, but understand this wisdom, which is why we do the show, should probably be 100% in equities at those ages and maybe quite a bit older, honestly.
Well, guys, I think we'll probably wrap it up there. I'm going to give Matt the last word today, since we're going to have Matt start and end the episode today. We started with your racing, and we're going to let you have the final word today. So a couple great questions today. I think both of them were actually related to each other in terms of saving long-term and what do we want to be putting in our investment plan for the long term. So I appreciate our listeners sending those in. So Matt, what would you say? What's the final word here today?
So, taking all of this information, it's like, okay, well, what decisions do I make? And it's like, well, you have to put it in the context of a financial plan. What is it I'm trying to accomplish? So do alternative investments or private equity or whatever it is that's either in the 401k plan or someone's talking to me. It's like, well, how does that fit in to the bigger picture?
That's right.
What am I trying to accomplish, and where does that fit in? Same with the article around people might have too much in stocks. Like, well, based on what? Like, what's the goal we're trying to accomplish? Like what Bill said, when someone's 30 years old and saving for retirement, well, they're saving, they're adding money. It's like, well, we want growth, not conservatism. So they should have more in equities, just, as a blanket example, versus, when someone's closer to retirement, being too much in stocks can be an issue. Again, you don't sell all the stocks, but it can be. But it's understanding, like, well, what are those components and how do they all fit together? You can't make a decision in a vacuum. And it's where a lot of these questions come from. They're just, it's a decision or a question based on just one input. Like, when's the best time to take Social Security? That's a recent webinar that we're hosting on Social Security. And it's like, well, you can't just answer when's the best time to take Social Security. You have to factor in every single other aspect of your financial life to come up with a educated decision and a framework to base that on. And that's really important.
Yeah. So you could say, when is the best time to take Social Security for you?
Yeah.
So
right.
there's no blanket answer, but there is an answer for you based on the factors and what's important to you and what your life situation is.
And we have a blast helping people put that puzzle together. I mean, that's what we love to do, is from all aspects of a financial plan.
That's right.
It's really fun for us.
And it is a puzzle. I think that's probably a good way to think about it, because when you put that puzzle together, you got the whole picture, you got this beautiful vision, and it really takes all of that.
And the pieces change every few years when the rules change.
Yes, they do.
Yeah. Well, great. Well, guys, thank you. As always, another great episode. And for each of you listening, if you want to learn more about Keen Wealth Advisors, please visit us at keenwealthadvisors.com. Please subscribe to this show if you haven't already. Also go to the YouTube channel, and we're posting the videos of the podcast there as well. And we would love for you to hit that subscribe button and even hit that notification button as well, so that every time a new episode comes out on YouTube, you're going to get notified of that. And we appreciate that. And of course, tell all your friends and family about the show. We really want to continue to expand the viewership and listenership of this, as we're really all about education too here. So appreciate that. So again, guys, thanks. And thank you to all the listeners.
Thanks, Steve. Thanks, Matt.
The Steve Sandusky Advisor Network and Belay Advisor are not affiliated with Keen Wealth Advisors. Opinions expressed by Steve are his own and not necessarily the opinions of Keen Wealth Advisors. Keen Wealth Advisors is an SEC-registered investment advisor. Advisory services are only offered to clients or prospective clients where Keen Wealth Advisors and its representatives are properly licensed or exempt from licensure. The contents of this podcast are intended for the residents of the United States of America. No advice may be rendered by Keen Wealth Advisors unless a client service agreement is in place. This program is intended for informational purposes only and should not be construed as advice on or a recommendation of any particular investment, strategy, or as tax or legal advice for your specific situation. Keen Wealth Advisors is not a tax or legal advisor. To determine which investments may be appropriate for you, consult your licensed professional prior to investing. Information in this program was compiled from sources believed to be reliable. Due to the constant state of data changing, we do not guarantee the timeliness or the accuracy of the information provided. Our views or opinions at the time you are listening to the podcast may be different than they were when the podcast was recorded. Past performance is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any prices that are referenced or market forecasts are as of the date stated and are not necessarily our opinions moving forward. As always, please remember, investing involves risk and possible loss of principal capital. This podcast is not allowed to be copied, distributed, published, or reproduced without permission from Keen Wealth Advisors.